G'day there, my name's Ben Everingham and I'm the director here at Pumped On Property, and in today's video I'm going to talk about 14 choices or 14 financial choices you will 100% regret in 10 years if you don't start to make changes now. So I'm going to talk about things like not paying yourself first, not investing a percentage of your income, selling and buying assets at the wrong time, not buying property and not buying shares, spending rather than investing or saving, thinking you actually have time, and a bunch of other really crazy and different ideas that I've learned over the last 8 to 10 years as an investor myself that I'm going to try and carry on through the next 8 to 10 years to continue to set myself and my family up for the future. So if it's your first time to my channel, welcome. I'm Ben Everingham. I'm the director here at Pumped On Property, and in the last 3 years I've helped my clients buy over $150 million worth of property in Sydney and Brisbane. I'm really excited about today's video. Please subscribe to our channel if it's something you'd like to do. I'll try and put out 3 of these types of videos each week. So the first thing is not paying yourself first, and this is just an absolute no-brainer. Every single person I've ever met that is wealthy or on their way to wealth or has a plan that they're actually executing pays themselves first, because there's so many expenses in life that come up by the time you look at all of the costs in your life and the income that you're generating. And so what I've done basically for the last 8 years since I finished university is focus on paying myself first. So in my first job after university, I was earning $55,000 a year. Every single week before I did anything else and spent any other money, I paid myself $400, which enabled me to go buy an investment property in the first year that I finished university in Sydney. So paying yourself first is really important. Paying yourself first is a concept and a habit to get into, and as your income increases, the amount of money that you pay yourself first should increase too. Now, paying yourself first isn't about putting money away for holidays and cars and stuff like that. You know, that's all money that you should have in your budget, but this is really money for saving and money for investing, and that is really all it's for. I just get the money transferred straight out of my account into another bank account that I don't have a card for, that I have to physically go into the bank to access if I need it. And once I've got a deposit there for a property, or I've got it for a business or another asset class, I then, redeploy that money, because savings in the bank at the moment ain't great for anyone that's getting interest at 2%. Paying yourself first is really important. You will 100% regret this in 10 years if you don't start doing it now. Now, when I was only able to put away 20 grand a year, which might be more or significantly less than you right now, I was still able to go and buy 11 properties over the last 8 years using that concept for myself with my wife. So it compounds over time, and as your income grows and your asset base grows, it gets a lot easier to pay yourself more. Now, the second thing I want to talk about is not investing 10 to 30% of what you earn. Now, I know there's people on this video right now that are going, shit man, I don't even have 1% of what I earn because I'm losing money every week just to tread above water right now. I completely understand that. I've been there myself before. But for other people on this video that are earning a 10 to 50% surplus every single week and aren't doing anything productive with it, start investing that 10 to 30%, or at least saving that 10 to 30% and put it away. For those of you that are keeping your heads above water, now is the time to review everything in your life, cut out all of the expenses that you don't need, and get back to a position where you're putting yourself in a safer financial position from a budgeting perspective. Now, this video isn't financial advice. I'm not a financial advisor, but I am an investor, and these are some of the lessons that I've learned. The third thing is not having a budget. It sounds like a no-brainer, but the difference between the investors, and I've talked to over 6,000 of them now in the last 5 years, the investors that are on their way to financial independence or already there, are the ones that just have a control on their money. It's the same as being healthy. What you put into your mouth and what you do with your time during the day in terms of movement changes your long-term trajectory over the next 10 years. Investing's the same. If you're not looking after what you're consuming and you're not reinvesting some of that money back, and have an actual budget that you can stick to that's realistic for you, then 10 years from now you're going to completely regret that, and you're going to waste a huge amount of money on absolute rubbish that you can't remember in 10 years time. Now, the fourth thing is something that 99% of investors make the mistake of, but the 1% of successful people, really successful people in the world, they understand this concept, and that is timing and selling assets at the right time as well as buying assets at the right time. Now, as Warren Buffett said, when is the right time to buy an investment? When nobody else is. Effectively, that is the best time. But obviously we go through these long periods of growth without a correction. And so the next best time to buy an investment is really at the start of a real estate cycle or the middle of a cycle, definitely not at the top of a cycle. The other side of that is true too, and most people sell investments when everybody else is selling to either cash out or when everybody else is selling because they're scared and the property market or the share market is dropping in value. So as an investor, I buy shares at the bottom of the 10% dip every year that's been going on for 70 years. I try and buy as many stocks as I can and shares as I can in the 30% dip, which has historically happened every 3 years for the last 40 years. And then once when that 17 to 18 or 20 year cycle comes around that wipes 50% off the share market, then that's your opportunity to buy. And those same things are true with property. You know, it's about going into that property market with confidence and buying at the right time, which is after a GFC or when the market's been sitting flat for a long time. Obviously, we only buy houses because we know they perform better, only buy metro markets because we know they perform better. Sydney, Melbourne and Brisbane is where the population and job growth is occurring, so I personally only buy those three markets. But selling and buying is an art form. You can learn so much more about this online. Really, the more you can learn about that and understand that, the better off you'll be in 10 years from now. You will regret not understanding that 10 years from now without a doubt. Now, the fifth thing is not paying principal and interest off your own home and your investment properties. With money being so cheap right now, you know, I'm taking advantage of that and I'm just wiping debt on as much as I can to 1, reduce my risk, 2, reduce my LVR, 3, set myself up for the future so that I can leverage off that equity and continue to move forward with other assets and investments. So, you know, why not have a third of your property owned in 10 years time? And yes, it's going to cost you a little bit more week to week, but 10 years from now, you probably will have got used to it and you won't have even noticed that you've smashed off all of this debt and you're in a much better cash flow and equity and long-term wealth position. So obviously not everyone can afford to do that, but for those of you that can, which is who I'm really speaking to here, you know, get stuck into that. The sixth thing is not having a world-class accountant and team of advisors around you. Now, I've had 5 accountants in recent times in the last 10 years. Most of them have been, to be honest with you, rubbish. They focus on the tiny % of accounting, which is saving you tax, and none of the asset protection stuff, none of the tax planning stuff, none of the wealth creation stuff. So get a good team around you and, you know, focus on people that have actually been there and done that. You know, I'm in the process of transitioning between accountants now because my current accountant didn't own as much investment property as I would like him to have owned, and it wasn't in that position that I was really comfortable with, where the new accountant, you know, owns a $4 million house on the beach outright, a bunch of commercial and residential property, and has sort of been there, done that from a life perspective too. Another thing that I wanted to discuss, there's obviously a bunch of things that I wanted to talk through today, but that is putting your super money in a managed fund. Now, I'm not a financial advisor. This is not financial advice, but what I did recently read was a great book. I think it's called Unshakable by Tony Robbins. He went out and did all the hard work that we all want to do, which is, you know, get access to the 7 or 10 most influential share traders in the world with the biggest managed and hedged funds. And he did a huge amount of research on the industry. And so from reading that book, which was short, I literally read it on the way to and from Melbourne from Brisbane. 4-hour book, very easy to read, very easy to process. But what he did was looked at the managed funds, which a managed fund is basically paying someone to invest your money into the share market for you. That's all it is. That's what's happening with your super fund right now, probably. That's probably what 90% of people do with share investing as well. If you've got a financial advisor, you know, that's what's happening there right now. But what I learned from this book is that the average return on the S&P 500, which is effectively the American stock market, and the ASX 200, which is the Australian stock market, is the average managed fund over a 10-year period, and these are the best managed funds in the world, I think 96% of them over the last 10 to 30 years performed worse than just buying the index, which is the average of all of the funds in the market. 3% per annum worse than the index fund. So these managed funds, they're just absolutely raping people on fees. They're not getting good returns. In fact, they're not even getting average returns in line with the marketplace. So it's really, really important to begin to understand managed funds. They'll sell you on how well they've done in the last couple of years because everyone's done well. An advisor of mine recently is like, Ben, look at your super money, it's doing so well, 17% return in the last 12 months. I'm like, well, it's in the American index. Like, that's what the American index did in the last 12 months. They're like, yeah, we're smashing it. And then I looked at I said, send me the 10-year average, and it was under 4%. I'm like, if I'd have just been in the index fund for the last 10 years, I would have got over 7% per year. So, it's important to learn these things. I think that book's a really, really good resource for those of you like me who are just getting my head around the stock market stuff. From a property market perspective, that's my specialty. But this is interesting stuff, and definitely, 10 years of 4% growth on your super money versus 10 years at 6 or 7% completely changes the game long term with that compound effect. The next one is not having a plan for your future. So probably 95% of the investors I've spoken with in the last 5 years have not had a plan for their future financially, and not had a definitive line in the sand when they want to be worth X amount of money, or they want to have X amount of passive income per year, let's say 100K within 15 years of passive income from property. So that's a really, really clear sign. If you don't have a clear plan for where you want to be in 1 year and 15 years, you're not going to achieve it financially. It's the same as anything else in life that you make happen, and it's up to you to take action to actually do that stuff. I'll run through some of the other things until we get to the end a little bit quicker. Spending rather than investing is just the absolute death of financial choices. Anyone that understands the effect of compound growth understands that the bigger the base at the start, the bigger the base at the end. It's really, really, really important to invest and not just spend. I know everyone in Sydney wants to own a nice car, and everyone in Melbourne wants to own the nice house near the nice school. That's cool. You just got to realize that they're liabilities, and they're adding to your ego, your comfort, your lifestyle, and your personal comfort, but they're not really adding too much to your long-term wealth position unless you see the house as an actual investment, or unless you can own that house outright sooner rather than later so that you can get on with the investing side of things. But spending more than you earn and more than you invest is deadly. Get in the habit of investing first. Another financial choice that I think I would regret, and most people would regret in 10 years, is focusing on the short term. I know everybody wants to get rich quick. Just pull that out of your mind and create long-term wealth with a low-risk strategy, and get stable and get financial stability and financial independence in your life before you start taking risk. But focusing on the short term kills your position in 10 years. Most people are living week to week, month to month, year to year. Get outside of that rubbish as soon as possible and start focusing on the bigger picture. Yes, financial independence might take you a bit longer than you want it to. There's plenty of people in the industry that will take your money and help you get rich quick, but most of these people won't be here in 10 years time when you're not, and all of these ideas have backfired on you. So just do the stuff that actually works. High quality houses, high quality shares, high quality businesses, and just focus on the long to medium term as well as short term, but keep your attention and time over there. Which takes me into the next one perfectly, which is point 11, and that's thinking you have time. Now, there's no such thing as getting rich quick, and I just talked about focusing on this short-term thing, which is deadly, as opposed to thinking about the long term. But the flip side of that is a lot of investors don't take action because we all think we have time. At 20, we think we've got time. At 30, 40, 50. I just spoke to a client before recording this video that was 57. Not a client, just someone that booked a strategy session with me, and I asked the question, when do you want to be financially independent? Tomorrow. was his response. What's your plan for doing that? He didn't have one. He was in a very average financial position in terms of income, no real control. Obviously nice new car, nice house that he had debt on, big renovation that he just completed. But that stuff, you know, he's 57, the options aren't really going to be there for him without taking on huge amounts of risk. And he's like, is there a higher risk strategy I can employ? And I'm like, sure. I'm just not the person to help you do that. Like, you know, unless you have 10 to 15 or 20 years to invest, it's not going to be easy, like, because you've got to go through a full cycle and you don't want to take on too much risk and expose yourself to too many issues. So thinking you have time is deadly. Just get your head around the market, get your head around one asset class or investment class, one market, one suburb, buy really high quality property, or, you know, if you're new to shares, look at the index funds rather than rolling the dice on hot tips from people that aren't financially independent themselves. Now these three of the 14 financial choices between 12, 13 and 14 are all completely connected. These are things that I would personally regret within the next 10 years, just from talking to so many investors and business owners that have put themselves in much better positions from focusing on these three things. And these are more the career side of the financial choices that you'll regret. So what we're really talking about here is not building the right skills in the job. And what I mean by that is either being lazy and getting to a point where you feel like, and I'm just going to call it for what it is, if you're not learning every single day and you're not growing as a person, or you're not treating your job like you're treating investing right now, and you're learning, you know, obviously watching this video, you're learning and you want to improve your life. But if you're not thinking the same way about your job, if you're not passionate about your industry, if you're not focusing on building skills and knowledge and capability every day, then you're just wasting your time and you're treading water, and you're going to be treading it for a lot longer than if you showed up fully in your role. So not building the right skills in the job comes down to two things. One, being lazy, and two, chasing short-term income at the expense of long-term skills. The skills that the market pay for and pay big money for is sales, managing other people, leading other people, and marketing. And obviously there's a whole lot of technical skill sets surrounding that, but they're the skills, the four things that the market is going to pay the most for, because they're the revenue generating sides of business, and they're the sides that require leverage and enable you to go to that next level. So I'll leave it at that. The second thing is, you know, and I've made the transition to the property industry, one, because I'm obsessed with property, two, because I'm selling or buying properties worth $1 million, and someone's going to pay me a lot more to sell or buy $1 million asset than they are to, well, actually I don't sell property outside of my own properties when I need to sell them. I've never sold property and I never will sell it. But when I buy property for myself and clients, you know, people pay big money because it's a big asset class and an expensive thing. And there's a lot of people out there right now probably listening to this video that are building skills in a low paying industry, and therefore it's either going to do one of two things. It's going to cap your income at some point in the future because your ticket item is small, or effectively it's just going to take you longer to get to financial independence, because if you're earning 50 grand a year versus earning 100 grand a year, then it's going to take you twice as long to save your deposits. The banks are going to lend you half the money, etc. So if you're a younger person in particular, sub 40, focus on the skill sets that build long-term wealth and value and that the market pays for, and focus on the industries where the money is. You know, focus on the industries where the high-paying jobs are. Focus on your passion as well. And that's the second last thing I wanted to focus on. Focus on your passion, because your passion is going to pull you through all the crap that we have to do working for other people, learning about investing, you know, making mistakes, learning as we go. But the thing about property for me is I have not showed up for work in 5 years, because even when I was working for someone else pre-starting this business, I got to do what I loved every day, which was talk to people who loved property as much as me. And now that I get to do this every day, you know, yes, there's hard days, yes, there's shitty months, yes, things happen and your mindset's not always 100% positive and on, but if you're doing something you love, you're being pulled through it rather than pushing yourself through it. And that will mean you build the skills, you build the contacts, you build the network to go to that next level. So focus on your passion. So the last thing that I wanted to focus on after your passion is working for someone else. Now, not everybody has the temperament, the skill set, the knowledge to go in and start their own business. Some people will never have that knowledge, skill set, or even inclination to want to go and do it. There's a lot of people with 95% of businesses failing within the first 5 years in Australia that, you know, you'd be better off just staying as an employee and focusing on that. But for those of you that do have that entrepreneurial spirit and flavour, working for yourself and putting 100% of the money that you earn in your own pocket is going to be significantly more profitable over the next 10 years than working for someone else. Now, I've got friends in good jobs, in good industries, but their earning potential is a tenth of what you can earn from running your own successful business. And that's because, you know, someone that is working as an employee is only ever going to get what they're prepared to work for, / what the industry is going to give them, / what their boss is going to pay them for the role, before they replace them for someone else that can go and do that as well. So running your own business is probably the most profitable thing that you can decide to do in the next 10 years. But, you know, you've got to have the knowledge and the skills and the passion and the ability to execute. And running your own business is a lot of leading people, marketing, selling, and adding value to other people's lives. And if you don't have those skill sets, then running your own business certainly isn't for you, and it would be very, very risky to go out there and do that. So I hope you've got some value out of the 14/15 financial choices that I think if you continue to do today, you'll definitely regret in the next 10 years. I've talked about a bunch of stuff like not paying yourself first, not investing, not having a budget, not paying your own home off, not paying principal and interest on investment properties after you've paid that off. You know, getting other people to look after your money and manage funds when the index fund does so much better. Focusing on the short term and all of those things I just mentioned in relation to your job and your industry. I hope you've got some value and some ideas from it. I hope I haven't been too brutal for those of you who this is the first video you've seen of mine. I'm Ben from Pumped On Property. If you're interested in really putting together an investment or property strategy, or just sharing some ideas with someone that's had some great experiences personally and as a business, I'd love to offer you a one-on-one strategy session with myself or my brother Simon. Just jump over to www.pumpedonproperty.com, where we'd love the opportunity to catch up with you about this, learn where you are, where you're looking to go, help educate you and bridge that gap so that you can not get there fast, but get there a little bit quicker than you may have on your own. So thank you for your time and attention today, and have a great day. Bye.